Twitter stock on Monday had its best day since its IPO, with shares up more than 27% after an SEC filing revealed Elon Musk, head of Tesla, SpaceX, acquired a 9.2% passive stake in the social media company. On Monday, Twitter stock jumped 27.1% to $49.97. The stock, which had dropped 38% in the previous year, through Friday's closing, added $8.3 billion to its market cap on Monday, bringing it to $39.3 billion. Now, Twitter's best day since its IPO. Let's take a look at some of the figures here. If you had invested about $1,000 in the stock, all right, so yeah, April 4th, stock was up 73% from its November 7th IPO. Through the, let's see, about 20, it's 38% down from its all-time high of where it was in February 2021. So it's an interesting investment with respect to Twitter. So yeah, $1,000 invested in Twitter April 4th, 236% up from that period. $1,000 invested in the IPO from November 7, 2013. You're still 90% up. If compared to the S&P 500 index from April 4th, 2017, that's up 93%. And from the IPO date of 2013, 161%. So interesting stats there on Twitter. Let's speak to our guest now, who, of course, is coming to us from South Africa. His name, of course, is Terence Hove. He is the senior financial markets analyst with Exness, which is an international multi-asset brokerage firm. Terence, good morning to you. Thanks, or rather, good afternoon. I think you're in Johannesburg. What do you make of the movement in Twitter, and does it bolster the case for tech stocks on the NASDAQ?
Thank you so much for having me on the show. Yeah, I think yesterday's announcement from Elon Musk really sent positive shockwaves throughout the market. I mean, as you mentioned, we look at how Tesla responded to that announcement with that massive gain. And that was also had another ripple effect to the index as a whole as well, which broadly the index performed really well yesterday. I think it also rode on that risk-on sentiment. That was the main driver in yesterday's trading sessions across different markets. So I think Elon Musk, very maverick type of investor, he's got 80 million followers on Twitter. So that definitely, was well received by the market. But one of the interesting things is this is a passive investment, passive shares, as you mentioned in your point, that is invested in in Twitter. So it's quite interesting to see what that is going to mean going into the future for the company itself. Notably that it's not big on advertising. So, in terms of revenue. So it's quite interesting to understand what this move means for Twitter and what Elon Musk is intending to do with these shares that he's currently now in possession of.
Thanks, Terence. I want to take a look at some data here. High growth tech stocks, they've been battered. They've had a tough first quarter. If we look at some of the headwinds, what are you telling your clients? Is it to cycle out into another sector, or stay the course and hope for the best?
Yeah, hoping for the best is a bit risky at the moment, to be honest, because a lot of geopolitical risks, as we are all aware. I think one of the key things, if we look at the beginning of the year, tech stocks, high growth tech stocks were not that popular anymore. Why? Because of this inflation narrative. So already there was this move to pivot into your essential type of, your value-based investments, which is most of your utilities type of corporates that are going to produce essentials for your consumers. So I think at this time in moment, more so now with a lot of the volatility in the market, with a lot of the risk and uncertainty in the market, you want to be in more of the essentials. That's where it's sort of like a lot more cautious and a lot more safer in the current environment at the moment. So yes, a bit more pivoting into those type of stocks as compared to your high tech at the moment. But as we saw yesterday with Twitter, high tech, when it does return, it really shoots out the roof.
Thanks for that. Okay, so now since we're talking volatility and where to cycle in and out of, I understand that Exness trades in CFDs, contract for differences. Apparently, this is a form of derivatives trading. Can you explain what those are?
Yes, correct. And that is it. So it's a form of derivatives trading, and essentially a derivative is an instrument that derives its value, hence the name derivative, from an underlying asset. So the real asset in this case. So trading in CFDs, or contract for differences, allows the investor to take part in the actual trading of a particular asset without owning the physical asset or having the legal obligation of delivery. If you own, say, for example, a barrel of oil, when the date comes, you needed to deliver the actual, barrel of oil. So whereas CFD exposes you to all those fundamentals and aspects of the actual asset, but without having to own the physical asset. So that's the benefit of it. And also, it's 24/7. You're able to stay up the whole night if you want to and trade through the market. But some sessions are less liquid than other sessions. So you tend to want to be trading when the sessions are more liquid and the markets are moving a lot more favorably.
Thanks. Can you talk to us about the risks, though, of CFDs? Because correct me if I'm wrong, I understand I don't think they're allowed as far as trading in the United States. Is it that because of the level of risk?
Yes, correct. So trading in general, in any form of trading, is very risky. Now, CFDs in particular are called over-the-counter products, which means they are not regulated. It's essentially transactions between yourself and myself, the buy on one end and the sell on the other end. And because of that over-the-counter nature of CFDs and the lack of regulation around it, they tend to be even a lot more risky, exposing your traders to potential risks. Remember, anything is risky in the world of financial markets, but these are potential risks. But with sound trading strategies, with sound preparation, these risks can very, very well be mitigated, allowing you to trade safely and very favorably, provided you are following these guidelines and measures.
Excellent. All right. So I think you have an FX trading portfolio. How has that performed in the first quarter of 2022 in these volatile times?
Well, that's putting me on the spot right there.
Sorry.
Well, yeah, it's so I had some very strong views at the beginning of the year, even internally with some colleagues, as we have our own catch-up session, and so some interesting clients as well who are very, very good traders, I've also taken some ideas from and learned from. So I was invested in gold. I had a bit of oil and one of my favorite currency pairs being the euro US dollar. Gold, beginning of the year, was looking to be a sell. Why? Because of the inflation narrative. But again, gold is a safe haven asset, and as we know it, end of February, the markets turned with the geopolitical tension, and gold glittered really, really well. So I had to change my view on that. Oil from the beginning of the year was always a buy, but that has happened a lot sooner and a lot more aggressively than anticipated, because beginning of the year, oil was anticipated to be triple digit by the third quarter. And it's all happened in the first quarter. I mean, with IC Brent getting as high as about $130 a barrel. So I think the first half was pretty stable, and then it got quite rocky. But I think it's done fairly well this past quarter of the first year.
Excellent stuff. Terence, we're out of time. I wanted to talk to you about yield curve inversion in the United States and fixed income, but maybe we'll have you back to discuss that. But thank you so much for your time. Terence Hove, Senior Financial Analyst with Exness. Appreciate your time.